So in this chapter, we will be focusing only about the macroeconomics, although we did that, you know, in the previous chapter also, but we discussed microeconomics a little bit as well. But from this chapter onwards, we will be focusing entirely on macroeconomics. So let me go to the slideshow from the start. So again, the difference between microeconomics and macroeconomics. If you remember, I did provide some example while explaining the microeconomics. So as an individual, when you're making your economic decisions, that will be something microeconomic analysis. And how the people interact in the market, that will also be microeconomics. On the other hand, in macroeconomics, we try to study the economy-wide phenomena. For example, if we are talking about inflation, if we are talking about unemployment problem, and if we are talking about economic growth, that all will be covered in our issues and discussions of macroeconomics. So again, microeconomic studies individuals unit and macroeconomic studies the aggregates. Now, a very important thing that you are going to learn in this chapter is about the gross domestic product, which is in short called as GDP. So what is GDP? If you hear the news or if you read the news, you might always come across about this GDP. So now you get to learn about this. So what is GDP? Well, GDP measures the total income of everyone in the economy. So whoever makes money in the economy, that will be calculated and added together. And that's how we get the income for the whole economy. So that total income of everyone is considered as GDP. On the other hand, there is another way of calculating the GDP, and that will be when you add all the expenses on the economy's output of goods and services. That will be a total expenditure. So that will also be, considered as GDP. So GDP can be calculated by calculating the total income of the economy or by calculating the total expenditure of the economy. So both should be giving you the right exact same answer. So for the economy as a whole, as we just discussed, you can calculate the GDP through the income method or through the expenditure method. So income must be equal to expenditure. So no matter which method you are using, your income should be equal to your expenditure for the economy as a whole. One of the reasons that why income must be equal to the expenditure could be, because that is something we learned in the circular flow diagram. If you remember the circular flow diagram, we can discuss about it a little bit again. So in the circular flow diagram, again, the assumptions that we took, that we made are like, we had two markets. One of the market was the market for goods and services, and the other market was the market for factors of production. And then we had two actors in the economy. One of them was household. So what the household did, household spent all of their income to buy all the goods and services that they needed, and the firms, they paid wages, rent, profit to the resource owners. So the households, on the one hand, they were the resource owners, and on the other hand, they were the buyer of various goods and services. As far as firms are concerned, on the one hand, they are the producers of various goods and services, and on the other hand, they were the one who were hiring the various resources and use that in their production to produce the goods and services. So again, this is the circular flow diagram. As you can see in this diagram, we have the same kind of setup that we had in chapter number 2. So we have markets for goods and services here, and markets for factors of production here. On the left hand side here in this blue box you have firms, and here you have households. So these links are kind of same that we discussed in chapter number 2, so you know about these. So that is the circular flow diagram. So when we are talking about the economy as a whole, this is also kind of circle like this. So this is kind of, a situation of imaginary economy. you may consider that as an imaginary economy, that will help us to understand what is going on. Now, the formal definition of the GDP, it stresses on the market value of final goods and services. Now, when you want to calculate the GDP, what you want to do is you want to take the final goods and services and then find out the market value. And another important point to be noted is that when you calculate the GDP, the production should be within a country. Anything which is produced outside, that should not be added in the GDP of that country. So for example, if something was produced in Canada, that cannot become part of US GDP. Of course, because that was not produced in the US. And another important point is GDP is calculated in a given period of time. So for example, if you're calculating GDP for 2013, so that will be 1 year time period. So you calculate GDP for a given period of time. Now, what does it mean that GDP is the market value? What do you mean by the market value? Well, if you want to calculate the GDP market value, then you need to know the market prices. So the market prices, they reflect the value of the goods. Okay, so whatever the prices that prevails in the market of that good that is produced, that is what they mean. Then the next important point is of all. When you are calculating the GDP, you need to add all the items that is produced in the economy. But here, one important warning. When you calculate the GDP, you need to add only the legally produced goods and services. You do not include any illegal production of any good or services. So only legal production becomes part of the GDP. So anything which is sold illegally, anything which is produced and consumed at home will not become part of GDP. Now the second part, what does it mean? Well, if you produce something in your home and you yourself is consuming it, that will not be becoming part of the GDP. For example, if you have a kitchen garden and you have produced some vegetables in your kitchen garden, so whatever you have produced, if you're consuming that yourself, so that production never went to the market, so it cannot become part of the GDP. So because we cannot, find out, what value it will have. So we need to find out the market value. Another example could be if there is a teacher and the teacher is teaching his own kid in his home, so his services never went to the market, so that will not become part of the GDP. So anything like that which is produced and consumed at home, that doesn't become part of the GDP. And anything that is produced and sold illegally, that also doesn't become part of the GDP. So you have to remember this, that these two things, should be excluded from the GDP. Then another important point in the GDP is the final. What do you mean by the final? Well, when you calculate the GDP, there could be different kind of products. Some products are kind of primary products, some products will be intermediate goods, and some products will be final goods. Let me provide you an example. Let's say there is a farmer who produced wheat, and the value of that wheat is $200. Now, when the farmer sells that wheat to a flour producing company, and that flour producing company convert that into flour, and now the value of that flour is $300. So that will be considered as the intermediate good. Now that flour is then being sold to a bakery company, and that bakery company convert that into a bread. So that bread, if it is sold to the final consumer who is going to consume that bread, that final bread is considered as the final good. So when you calculate the GDP, you must make sure that you are adding up the value of the final goods. So you don't want to include the intermediate goods, because the value of that intermediate goods is already in there in the final goods. But because if you do not, if you're not careful about it, then you might come across the problem of double counting. Okay, so let's say the value of the bread is 500 and the value of the flour is 300. If you want to add 300 as well as 500 as well as the value of the wheat, which was 200, Then wheat will be counted 3 times, and the flour will be counted 2 times, and bread will be counted 1 time. So basically, you counted wheat 3 times and you counted the flour 2 times. So that is causing the problem of double counting. You are adding up some of the things twice and some of the things thrice, which is no good, and that might result into inflated GDP, and you don't want to uh, don't want that to happen. So therefore, always make sure that when you calculate the GDP, you need to take into account only the final goods, prices of the final goods. Next thing is, when you calculate the GDP, you need to take into account both the goods and the services. It's not just the good, also the services. So it will include any tangible goods, any intangible services. So whatever you produce like cloth, wheat, computers, you know, and any kind of services like services of a doctor, services of a lawyer, services of a teacher, okay? So you need to add all of them to calculate the GDP. Now, what do you mean by produced? Well, produced means what is currently produced. Anything which is produced like long time ago, you cannot add that when you calculate the GDP of the current year. So only currently produced goods and services should become part of the GDP. So if you calculate the GDP for 2013, you cannot take into account any production that took place before 2013. So therefore, that is very important point to be noted, that anything which is produced before cannot become part of the GDP. It should be only currently produced. So for example, if you bought a car like in 2007 and you sold that car in 2013, so whatever money you made out of that transaction, that cannot become part of the 2013 GDP, because that car was produced in 2007. So in 2007, when you calculated, when GDP might have been calculated, at that point of time, the value of that car might have already been included. So it doesn't make sense to include the value of the car again in 2013 when it was sold. So only new goods and services that is currently produced becomes part of the GDP. Then another important point is within a country. When you calculate the GDP, you must make sure that you are taking into account only the goods and services which are produced inside the country. Okay? So regardless of the nationality of the producer. For example, if there is a US citizen who is working in Germany, so whatever money that person is making will not become part of US GDP. Why? Because although that person is a US citizen, but he is not working for the US, he is working for Germany. So whatever money he makes, that becomes part of German GDP, not the US GDP. On the other hand, if there is a Canadian citizen working in the US, so whatever money that Canadian citizen is making, that becomes part of US GDP, because although that person is a Canadian citizen, but he is working for the US. So whatever money he is making, that becomes part of the US GDP, not the Canadian GDP. So GDP doesn't distinguish whether that production is done by a foreigner or a citizen of that country. What matters is where it was produced. Anything which was produced inside the country, that becomes part of the GDP. Anything which is produced outside the country, even though that is produced by the US citizen, will not be becoming part of the US GDP. Then the last is in a given period of time. So GDP can be calculated for an year. GDP can be calculated for quarters. So we can calculate for a given period of time. Now this slide is discussing about the components of the GDP. So basically this equation is going to be very important for you from now on. So in this we have this capital Y equals capital C plus capital I plus capital G plus NX. So what do you mean by these? Well, Y is GDP, C is consumption, I is investment, G is government purchases, NX is net exports. So if you add the consumption, if you add the investment, if you add the government purchases, and if you add the net exports, you should be able to calculate the GDP. Now, what do you mean by net exports? Net exports means export minus import. So that will be added if you want to calculate the GDP along with consumption, investment, and the government purchases. Now, what do you mean by consumption? Well, everybody knows what is consumption, which is in shortcut, we call that as capital C. So consumption is the spending by the households. So whatever households they buy, they spend on the various goods and services, that will be the consumption. But a very important point here, when the households are buying new houses, so that will not be part of consumption expenditure, but rather it will be becoming part of investment expenditure. Okay, again, whatever households spend to buy the various goods and services, that becomes part of the consumption expenditure. But if the households are buying new houses, that does not become part of the consumption expenditure. So that is a very important point that you should be noticing and taking into account, because some of the questions might be asking and might want to check your knowledge about this. Now, the second component that we had in that equation, if you remember, was investment. So what is investment? Well, the firms, they spend on capital equipment. When they start their production, they need to buy the capital equipment, inventories, and they also need to buy the structures. So whatever they spend to buy all of these, that become part of the investment. Along with that, the households, when they buy new houses, that becomes part of the investment as well. So see, in the consumption, we excluded the purchase of new housing, but we added this in the investment expenditure. So that is interesting, right? Otherwise, other than this point of the household, everything else is the forms. And any inventory accumulation is also a part of the investment. So let me provide some example. So if you are buying an old house that was, built in, let's say, 1991. So that house was built in 1991, and if you bought that house now, that will neither become part of consumption expenditure nor it will become part of investment expenditure. Now you might wonder that just now you told that purchase of housing become part of the investment. Well, I told purchase of new housing. So this new word is important. If you purchase an old house, that is not going to becoming part of the investment. So purchase of new house, right here, purchase of new house is a part of investment expenditure. So consumption, it never becomes part of consumption expenditure, but it becomes part of the investment expenditure. So if you buy an old house, it will never be a part of investment expenditure and will not be included in the GDP. Therefore, you have to be careful when you are answering the question, and only when the house is new, then only you are going to add that up in the investment expenditure. Now, what do you mean by inventory accumulation and spending on capital equipment? You know that when the firms, they start their business, they need to buy all of that stuff. So if there is a firm who produced like 10,000 units of a good and they sold 9,000 units during the year, and if they are left with 1,000, you must be adding that up in the GDP as well. Although that is not sold, but still that is that is produced, therefore that becomes part of the GDP. Then the next component is government purchases. Government, they need to spend on a lot of things. So they spend on various programs. They have to spend on the various government consumption expenditure, and also they make a gross investment. They need to spend on various goods and services. They have to maintain the law and order. They have to pay the salaries to their workforce. So everything that the government need to spend to work, that becomes part of government purchases. But in one important thing that does not become part of the government purchases is the transfer payment. So anybody who collects any kind of unemployment benefits and any kind of social security, that will not be becoming part of the government purchases. So that should be excluded when you calculate the government purchase. Then the last component is net exports. To calculate, as I said before, to calculate the net exports, you need to take the exports and then subtract the imports, and then you get the net exports. As far as export is concerned, export will be when a country sell their stuff to a foreign country. Okay, so they have produced that stuff in their country, and then they are selling that stuff to a foreign country. That becomes export. On the other hand, if you are buying a stuff that is produced in a foreign country, that will be considered as imports. So everybody knows what is export and import, so we don't want to spend a lot of time discussing about this. Now here is some data, although this data is little bit old, but not that old. As of 2012, the GDP of the US was over $50 trillion. So that is calculated, that might have been calculated maybe by using the income method or the expenditure method. And then GDP per person during that year was $49,923. That's pretty impressive, isn't it? Consumption is 35,411 per person. Investment was 6,557 per person. Government purchases was 9,758 per person, and net exports was a negative 1,806 per person. Now you might wonder that why net export is negative. Well, the situation of the US from past many years is that their imports are exceeding their exports. So when you calculate the net exports, you need to take the export and then subtract the import. But think for a while, if import is greater than the export, wouldn't it come out to be negative, right? So that is the reason why we have this negative 1806 per person as the net exports. So don't wonder if the net export is coming out to be negative. It can, and it is very common. So that is why we have this kind of situation. As you might notice that out of the four components that we had in GDP calculation, which is C plus I plus G plus NX, out of that consumption expenditure is the highest, right? And the second is government purchases, and the third is investment, and then finally the net export, which is negative. So that was the situation in 2012. Now this table, as you can see, is showing you in the form of a summary. So GDP, which is abbreviated as capital Y, the total of that was 15,676, and per person GDP was 49,923, and the percent of total is 100%. Consumption was 11,119, then per person was 35,411, and the percent was 71%. So consumption was 71% of the entire GDP. So that is pretty big, right? And the investment was 2,059 total, and per person was 6,557, and it was 13% of the total. And the government purchases was 3,064 total, and per person was 9,758 per person, and then percent of total was 20. Net exports was negative 567, and per person was negative 1806, and then percent of total is negative 4%. Let me see what was shown in this case. So basically these data that we had was for the per person. So as you can see that everywhere we have per person. Okay, so that is the same thing we can see right here in this second column. So don't get confused, the data here in this slide is per person, all right? And here the data is right here. You can go back and through and see what's going on. Now, a very important difference that you need to know and understand in macroeconomics is about the difference between real versus nominal GDP. What does it mean? Well, you know that if you are calculating the GDP, you calculate that on the basis of the market prices. But market prices doesn't remain stable, it keep on changing. So when the prices change, then it will also have an impact on the GDP, isn't it? So if the GDP increases, let's say the GDP of 2012 was, say, let's say, 10 trillion, and the GDP was 2000 for 2013 was somewhere 12 trillion. So we might not know that what caused GDP to go up. Maybe it is because of the prices, or maybe it is because of the actual production. So to calculate the nominal GDP, what you normally do is you take the production of the various goods and services during that given period of time, and then you value that at the current prices. So for example, if you produce 100 tons of wheat and the price of each ton of wheat was $1, that will give you $100. Then you also produce some milk, and then you take the quantity that was produced and then multiply it by the price of the milk per unit, and then you can get the dollar value of that. So you keep on doing that and then add them together, and that's what will be giving you the nominal GDP. As far as real GDP is concerned, real GDP also try to calculate the production of goods and services, but to calculate the real GDP, you take the constant prices. Now, what do you mean by the constant prices? Well, we need to assume that 1 year as a constant. We will be taking some examples and to understand what you mean by that. So that is designate 1 year as the base year. So if you have several years in your data, then you can consider one of the year as the base year. That is not affected by the changes in the prices. All right. So for the base year, the nominal GDP is equal to real GDP. That is interesting. So if you are asked in a question to calculate the nominal GDP as well as the real GDP, you can be sure that the base year nominal GDP is going to be equal to the real GDP of that year. Now here is an example that explains the difference between the real and the nominal GDP. So whatever we discussed in the previous two slides is going to become more clear after you understand this example. Now this example will also be helpful when you do your Canvas assignment, which is due this week, or maybe for the other classes it might be due later on. So whatever the case may be, it is going to help you in doing some of your work. So please try to concentrate and understand what is going on in this example. So the real and the nominal GDP you have given in this table, the first column shows the year. So you have 2013, 14 and 15. And we have a product, hot dogs. The price of hot dog are given. In 2013, the price of hot dog was $1. In 2014, it is $2, and in 2015, it's $3. The quantity of hot dogs was $100 in 2013. In 2014, it was $150, and in 2015, it is $200. The price of hamburgers, it was $2 in 2013, $3 in 2014, and $4 in 2015. The quantity of hamburgers was 50 in 2013, 100 in 2014, and 150 in 2015. So if you want to calculate the nominal GDP, what you must do is, in 2013, say the price of the hot dog was $1. So you take the $1, which was the price per hot dog, and then you multiply with the number of hot dog produced. So what was that? 100. So 100 hot dogs. And plus what else was produced during that year. So in 2013, you produce hot dogs and you also produce hamburgers. So for the hamburger, each hamburger was sold for $2. That was the price. And the quantity was 50. So we wrote 50 here. So if you multiply this, 1 times 100 is going to give you 100, and 2 times 50 is going to give you again 100. 100 plus 100 will be giving you 200. So that is your nominal GDP for the year 2013. Similarly, you can calculate the nominal GDP for 2014. You just need to take the prices of that year. So in 2014, the price of hot dog was 2. That's what we wrote here. And the quantity was 150. That is what we wrote here. Plus the other product that is produced, which is hamburger. The price of that product in 2014 was 3. And the quantity produced was 100. So if you multiply them, you are going to get 300 here. And if you multiply these two, again you get the 300. So 300 plus 300 is going to give you 600. Similarly, you can do that for 2015. So price is 3. The quantity of hot dog is 200. 3 times 200 is going to give you 600. And for the hamburger, the price was 4 and the quantity is 150. and if you do the math and add them together, you should be able to get 1200. So that shouldn't be hard for you to understand. I hope you are able to understand what I'm talking about. I'm sorry, I need to go back because I just explained only the nominal GDP. Now, how to calculate the real GDP? Well, as I said before, when you calculate the real GDP, you must assume one of the year as your base year. If no information is provided, you can assume the oldest year as your base year. All right. So among these years, which is 2013, 14, and 15, the oldest year is 2013. So we might assume that 2013 as your base year. That's what they wrote, base year 2013. So you need the base year information only when you calculate the real GDP. When you calculate the nominal GDP, you do not need that because nominal GDP is current year prices and current year production. But real GDP takes um, the price of the base year but the quantity of the current year. Let's see for 2013. So in 2013, the price of the hot dog was $1, right? And the price of hamburger was 2. And the quantity was 100 for hot dogs and 50 for hamburgers. So 150. So as you can see, this is 200. Now, if you remember, I told you before, for the base year, the nominal GDP is equal to real GDP. So base year is 2013. And 2013, nominal GDP was 200, right? And when we calculated the real GDP for 2013, it also came out to be 200. So 200 and 200 are the same. So again, for the base year, the nominal GDP is equal to the real GDP. Now, if you want to calculate the real GDP for 2014, what you do is you take the prices of the base year, which is 2013, and you know what were those prices. For 2013, the price of hot dog was $1 and the price of hamburger was 2. But you take the quantity of that particular year. So the quantity for hot dogs in 2014 was 150. That's what you wrote here. And the quantity for hamburgers is 100. That's what we wrote here. So if you do the math, 1 times 150 is 150 and 2 times 100 is 100, and adding up together you get 350. So 350 is the real GDP for the year 2013. I'm sorry, 2014, considering base year as 2013. All right. Now finally, you can also calculate the real GDP for 2015. So again, you will be assuming the base year as 2013, and you take the prices of the base year, which is for $1 and $2 for hot dog and hamburger respectively, but you take the quantity of that particular year. So in 2015, the quantity is 200 for the hot dogs and 150 for the hamburgers. So that's what we have, 200 and 150. Then you multiply and add them together, and that's what we get, the real GDP for the year 2015. Now you can do another thing here. What you can do is you can calculate the GDP deflator. So to calculate the GDP deflator, what you do is you take the nominal GDP in the numerator, okay? And then you take the real GDP in the denominator and then you multiply it with 100, and that's how you get the GDP deflator. So for the base year, as we know that for the base year, the real and the nominal GDP are the same. So that's why we have 200 here in the numerator, and then we also have 200 in the denominator, because the real and the nominal and the real GDPs are the same for the base year. So our GDP deflator for the base year is going to be 100. Now for 2014, your nominal GDP was 600. That's what we have here. And in the denominator, you have the real GDP for that year, which is 350. And then you multiply it with 100 and you get 171. For 2015, your nominal GDP for that year was 1200. And then you divide it with the real GDP for that year, which is 500. And then you multiply it with 100, and that's what you got, 240. Okay. So basically what the GDP deflator tell us, GDP deflator actually is a kind of ratio of the nominal GDP to the real GDP times 100. So if you want to write down in the form of a formula, you can write down the nominal GDP in the numerator and then real GDP in the denominator and then multiply it with 100. So GDP deflator will be 100 for the base year, as we saw in our example. The base year was 2013, and when we calculated the GDP deflator for the base year, it came out to be 100. So that is what we have right here, the information. So basically what GDP deflator is trying to do? Well, it measures the current level of prices relative to the level of prices in the base year. So it can also be used to calculate the inflation, how much inflation is there. Okay, so that can be helpful to analyze and deflate the nominal GDP and try to do the comparisons. So that is a very important tool that can be used. Okay, so now let us talk about the inflation a little bit. So if you have the GDP deflator information with you, that information can be used to calculate the inflation rate. Okay, so inflation is basically the situation where the economy's overall price level is rising. And if you want to calculate the inflation rate, then you need to take the percentage change in some measure of the price level from one period to the next. So excuse me. So if in this example that we took before, you had the GDP deflator in one of the year 2, and then GDP deflator in another year 1. So your formula will be like this. You take the GDP deflator in year 2, and then you subtract the GDP deflator in year 1, and then divided by the GDP deflator in year 1 and multiply 100. So that formula is going to help you when you're doing your work, and you might be needing that when you do your assignment. So please keep that formula handy when you are doing your assignments. Now the GDP data that we have, that can show us like a lot of different things. It can also tell us if the real GDP is growing over the time, and it can also tell us about the growth. Okay, so the average growth rate was 3% per year since 1965, which is pretty decent, but we can definitely try to improve it. But the growth is not steady. Okay, because GDP growth might have influence because of the various business cycles and the economic situations. Let's say current situation, we have recession that is going on from past many years. It's getting a little bit better in between, but still things are there which needs more attention. So recession is basically the situation where the 2 consecutive quarters of falling GDP. So if you calculate the GDP quarterly, and if you notice that the GDP is falling consecutively for 2 consecutive quarters, that might be considered as that situation. So real GDP will be declining in the case of recession, and then your country will have lower income, people will be having lower income, and then rising unemployment. It might also cause people to become unemployed, lose their jobs, and businesses will be earning less profit, and also might be causing bankruptcies because of several problems that the firms and the households and the people face during such time. So this is a kind of graph that shows the real GDP of the US. It starts from 1965 and goes until 2010 and after a little bit. So as you can see that this is rising, but there are some, in between there is some period where it is down. So this will give you some idea about what is going on in the US from the past couple of decades. So GDP can help us in understanding a lot of things. So it is one of the very important measure that is needed and used widely by the economists to analyze the economic situation. It also tell us about the total income. As we discussed before, GDP can be calculated by adding up the total income of the country, or it can also be calculated by adding up the total expenditure. So if a country has larger GDP, it should be able to enjoy good life, better healthcare, and also better educational systems. So GDP can help us in analyzing the country's living standard situation and a lot of other things. Okay. But GDP cannot tell us a lot of things. For example, GDP cannot tell us about the leisure. So, for example, if a person is working really hard and is very productive, but what if that person doesn't have any time to spend with his family? So that is something GDP does not take into account. And also anything which is produced in home, and the product and the production that doesn't enter the market, that doesn't become part of the GDP. So in those cases, it seems that GDP might be undervalued. Also, GDP does not take into account the quality of the environment. There are some countries which are doing very well as far as GDP is concerned, but that might be at the cost of their environment. So that is something is a big concern. If you're able to produce a lot, but it is costing your environment and making the life worse for the people living in those countries, then that is not considered very good. So that is something GDP does not take into account. And also GDP does not tell us about the distribution of income. Although you can calculate GDP per person, but not everybody gets the same amount of money. That depends upon the distribution. So it does not tell us about the distribution of income. Now, at the international level, if you compare the GDP and the quality of life, the rich countries normally they enjoy higher GDP per person. When they have higher GDP per person, they can expect a higher life expectancy. So people who lives in the rich country, they live a long life. They are more literate, and internet usage is also greater. On the other hand, in the poor countries, because they have lower GDP per person, so the life expectancy will not be that high. The population is not very educated or literate, and the internet usage is also very low. Low GDP can also be a concern in cases where the infants who are born, their birth will be on a lower side. There might be cases of higher rates of infant mortality. Also, the mother's maternal mortality might also be higher. The children who are born, they might be malnourished, malnutrition problem. There might be also a problem of safe drinking water because they cannot afford to have advanced equipment that can take care of the water quality and stuff. And then school age children might not be in the school. There will be less children in the school because the parents cannot afford the school fees and stuff. Although schooling is free in the US, but not in the rest of the countries of the world. In some countries it might be free, but in many countries it is not free. So that might be the reason. Some other concerns are few teachers per student. So if the population itself is not very literate, so how they can produce enough teachers? There will be fewer telephones, less telephones, paved roads, and also fewer households with electricity. So people will not be having that much electricity connection. So that might be another problem. So this is a kind of summary which gives us an idea about the situation of different countries. As you can see that United States real GDP per person is 43,017, and the life expectancy in the US is 79 years. Average years of schooling is 12 years, and they are satisfied with their water quality is 90%. Germany GDP, real GDP is a little bit lower than the US, but their life expectancy is a little bit higher, 1 year. But average schooling is kind of same, and satisfied water quality is 95. So you can just go through all of them. That gives you an idea what's going on. So that is all about this chapter. I hope you did understand this chapter and it gives you a better idea. Thank you so much for watching this video, and I will be posting other videos as and when I get the time. Thank you so much. Bye bye.